If you think holding cash is safe, this video might completely change how you see money. Cash is not failing when it loses value over time. It is doing exactly what it was designed to do. Modern economic systems are built on the assumption that money should gradually lose purchasing power so that people are encouraged to spend, invest, lend, and take risks instead of hoarding currency. If cash reliably gained value simply by sitting still, there would be little incentive to build businesses, improve productivity, or fund innovation. Economic activity depends on money moving, not resting. This is why inflation exists not as an accident, but as a structural feature of the system. When new money is created, it does not spread evenly across society. It enters the economy through specific channels such as governments, banks, financial institutions, and large corporations. These early recipients are able to spend the money before prices rise. By the time that same money reaches salaries, savings accounts, and everyday consumers, prices have already adjusted upward. Holding cash places you at the very end of this distribution chain, where purchasing power is weakest. Even in a well-functioning economy with no crisis, the money supply expands every year to support growth, debt repayment, and credit creation. That expansion mathematically reduces the value of every existing unit of currency. Nothing has to go wrong for this to happen. There does not need to be hyperinflation, corruption, or mismanagement. The system itself applies a slow, constant pressure that erodes idle money over time. Cash is a dilutable instrument, and dilution is the price paid to keep the broader economy functioning. Economies are not built on saving alone. They are built on velocity, circulation, and exchange. Money that sits still works against that goal, so the system quietly penalizes it. Treating cash as a long-term store of value is not conservative, even though it feels that way emotionally. It is a voluntary decision to absorb the cost of dilution so that others can transact, borrow, and invest. Cash is meant to be temporary. It is a medium of exchange and a short-term holding place, not a vehicle for preserving wealth across decades. When people hold cash long-term, they are effectively agreeing to lose purchasing power in exchange for stability and simplicity. This loss is predictable, consistent, and built into the design of modern money. That is why cash, by definition, cannot protect wealth over time. It exists to move, and the longer it stands still, the more value it quietly gives up. Cash falls behind inflation not only because prices rise, but because cash itself has no internal mechanism to respond to that rise. Once money becomes cash, it stops working. It does not grow, reinvest, or adapt to changes in the economy. A physical bill or a static balance in an account represents a fixed claim, and that claim weakens as the economic environment expands around it. The purchasing power of cash peaks the moment you receive it. From that point forward, time works against it. Each passing year reduces what that same amount of money can buy, regardless of how stable the number looks on a screen. Unlike productive assets, cash does not compound. It does not generate additional value on its own, and it does not participate in economic growth unless it is actively deployed. Businesses reinvest profits, adjust prices, expand operations, and increase efficiency. Real estate benefits from rising rents, higher replacement costs, and long-term demand tied to population and income growth. Equities reflect earnings growth, dividends, buybacks, and nominal expansion driven by inflation itself. These assets may fluctuate, but they contain internal systems that allow them to move upward over time. Cash contains none of these features. It is static in a dynamic environment. This difference creates a powerful asymmetry. Assets naturally transmit inflation through price adjustments and reinvestment. Cash absorbs inflation without resistance. If inflation is a rising tide, assets float upward while cash remains fixed in place. The damage is not dramatic in the short term, which is why it is often ignored. A few percentage points of inflation per year does not feel urgent, but over long periods it becomes decisive. A modest inflation rate combined with zero growth guarantees a steady loss of real value. The absence of compounding is far more destructive than inflation alone. Holding cash long-term also imposes a constant mental burden. To preserve value, the holder must continuously decide when to move, where to allocate, and how to respond to economic changes. Timing, prediction, and discipline become mandatory. Productive assets remove that burden by default. They adjust automatically as earnings grow, prices rise, and capital reinvests itself. One side of the equation grows without intervention, while the other decays unless it is constantly managed. This is why long-term wealth has never been built by holding money alone. Cash provides liquidity and flexibility, but those qualities do not generate growth. They only delay action. Until cash is transformed into ownership, time remains an opposing force. The moment compounding begins, the math shifts. Until then, the value of cash steadily erodes, quietly and predictably, simply because it has no way to grow. Holding cash places a person on the passive side of a financial system that is actively designed to reward ownership, leverage, and participation. Modern economies are not neutral environments where every choice is treated equally. They are structured around credit expansion, asset ownership, and continuous movement of capital. When someone holds cash long-term, they are not opting out of the system. They are supporting it from a disadvantaged position. Their purchasing power becomes the stabilizing force that allows other participants to benefit. When inflation rises, asset holders adjust almost automatically. Businesses increase prices, landlords raise rents, and equity owners see higher nominal valuations. Borrowers benefit as well because their debts are fixed in nominal terms. As incomes and prices increase, the real value of what they owe declines. Cash holders, however, do not adjust at all. They experience inflation as a direct loss rather than a transmitted effect. Every increase in prices reduces what their money can buy, and there is no compensating mechanism to offset that loss. This imbalance is not accidental. Economic growth in modern systems is driven by debt. Governments run persistent deficits. Corporations refinance and expand through borrowing. And banks earn profits by lending money into the economy. For this structure to function, money must circulate. Capital that sits idle disrupts velocity. So policy incentives are consistently shaped to discourage long-term cash holding. Low real interest rates, inflation targets, favorable treatment of debt-backed activities, and asset price appreciation are all side effects of this design. The result is predictable. Those who own assets or use credit benefit from the system, while those who hold cash subsidize it. Cash holders effectively become shock absorbers. They take on inflation risk so that debts can be serviced more easily elsewhere. Their lost purchasing power helps stabilize the real value of outstanding obligations across the economy. From a systemic perspective, this is useful. From an individual perspective, it represents an invisible transfer of wealth. Nothing is taken directly, and no single event signals the loss, but the outcome is the same. Over time, the cash holder ends up with less real economic influence despite doing nothing wrong. This dynamic explains why long-term cash holders often feel that the rules are stacked against them. They save diligently, avoid excess risk, and behave responsibly, yet they fall behind. The system rewards the opposite behavior: participation, ownership, and the strategic use of debt. Holding cash may feel prudent, but in a credit-driven economy, it places the holder in a structurally weaker position. Inflation does not merely happen to them. It works through them, transferring value outward to those positioned on the other side of the financial system. Holding cash creates a sense of safety that is largely psychological rather than structural. The balance appears stable. The numbers do not fluctuate, and there are no visible losses from day to day. This stability feels reassuring because it removes the emotional stress that comes with market volatility. There are no sudden drops, no negative headlines directly affecting the value in your account, and no moments of panic. However, this calm is deceptive. What looks like safety on the surface is actually a slow and continuous trade of long-term security for short-term emotional comfort. When people compare cash to assets, they often focus on volatility. Cash does not go down in nominal terms, while stocks, real estate, and businesses can fluctuate dramatically. This leads to the conclusion that cash is safer because it avoids visible losses. The real comparison, however, is not between movement and stillness, but between visible volatility and invisible erosion. Assets may rise and fall, but cash steadily loses purchasing power without making noise. The loss is quiet, predictable, and rarely acknowledged, which makes it easier to tolerate even as it accumulates year after year. By choosing cash, a person avoids both downturns and recoveries. Short-term pain is eliminated, but so is long-term upside. Over time, this trade becomes increasingly expensive. Compounding gains, asset repricing, and participation in economic growth are all sacrificed in exchange for emotional ease. These costs do not appear as losses on a statement. They show up as opportunities that never materialized, which makes them psychologically easier to ignore but financially far more damaging. Cash does not remove risk. It changes the type of risk being taken. Instead of market risk, the cash holder assumes inflation risk, reinvestment risk, and longevity risk. Inflation steadily reduces purchasing power. Reinvestment risk grows as the future becomes more uncertain and the cost of entry into assets rises. Longevity risk emerges as time extends and money must last longer in an environment where each unit buys less than before. Unlike market downturns, these risks do not reverse. Markets can recover after crashes. Lost purchasing power from inflation never rebounds. This is why holding cash long-term is an expensive form of protection. The price is paid gradually through missed growth rather than sudden loss. It feels responsible because there are no dramatic failures. Yet the outcome is often worse than taking calculated exposure to productive assets. The comfort cash provides is immediate and emotional, while the cost is delayed and abstract. Over time, that imbalance grows, turning the illusion of safety into one of the most costly financial decisions a person can make without ever realizing it. Cash delays the moment when wealth actually begins to work. While money remains in cash form, it is passive. It does not participate in growth, repricing, or compounding. It simply waits. During that waiting period, time continues to move forward, but nothing is being built in the background. Income may still be earned and balances may rise. Yet the fundamental engine of wealth creation remains off. This creates a quiet gap between effort and outcome, where discipline exists but progress feels slow or completely absent. Wealth only compounds after cash is converted into ownership. Ownership changes the role money plays in a person's life. Instead of relying solely on labor and income, ownership creates exposure to systems that grow beyond individual effort. Businesses expand, assets reprice, and future cash flows are claimed through equity, property, or other productive holdings. Until that conversion happens, money remains outside the compounding loop. Every year spent holding cash is a year where no reinvestment occurs. No structural growth takes place, and no leverage works silently in the background. This delay has a cost that compounds just as powerfully as returns do. Time does not pause while someone waits for certainty, perfect timing, or emotional readiness. The economy continues to move. Assets continue to appreciate, and opportunities become more expensive. The longer cash stays unconverted, the wider the gap becomes between those who position themselves early and those who remained in preparation mode. The cost is not obvious because it does not appear as a loss. It appears as stagnation, a sense of being financially stuck despite doing everything right. Cash often creates the illusion of progress because balances can grow through saving alone. This can feel productive and responsible. Yet net worth does not meaningfully change until ownership begins. Saving builds capacity, but it does not build momentum. Without ownership, there is no mechanism for growth to accelerate over time. This is why many long-term savers reach a plateau where effort no longer translates into noticeable advancement. The preparation phase extends indefinitely, and financial identity remains frozen in place. Cash is not meant to be a destination. It is a transition state between earning and owning. When it remains a destination, it quietly prevents wealth from compounding. The longer someone stands in that in-between state, the more time works against them instead of for them. Ownership is the switch that activates compounding, and every delay in flipping that switch carries a permanent opportunity cost. Time passes either way, but only ownership allows it to create lasting financial progress. If this changed how you see money, check out my other videos right here. They'll help you think richer faster.